Hello, and welcome to the Dr. Money Matters podcast, the show where we discuss important financial topics that were never covered in med school. I'm your host, Dr. Tarang Patel. Today's episode is about student loans. If you are or recently were in medical, dental, or any other health professional school, you already know that education costs are out of control. For example, at the University of Pennsylvania, one of the nation's best medical schools, tuition and fees totaled $1,200 in 1960. By 1990, it was $20,000, and by this past academic year, it's over $58,000. This is insanity and completely unsustainable. Obviously, incomes have not kept up with this rise, and therefore students are almost forced to go into higher paying specialties in order to have any chance to pay back their loans. Consider sending a link of this podcast episode to your congressional representatives to think before they make any changes in student loan policies. And also, maybe we should contact our alma maters and tell them that continuing to raise tuitions at this rate is completely jeopardizing the ability of many to enroll in these schools, and therefore it's becoming a concern for access to healthcare for the nation as a whole. Anyways, enough about the soapbox. Let's get to this episode with my guest, Travis Hornsby of StudentLoanPlanner.com. Travis is an entrepreneur who learned early the value of staying away from debt and now uses his knowledge to help the many Americans burdened by student loan debt. Welcome to another episode of the Dr. Money Matters podcast. Today our guest is Travis Hornsby of StudentLoanPlanner.com. And obviously, student loans are a major issue in medical and dental students and residents and early practice life because it's just taking longer and longer to pay these loans back. So Travis, tell me about yourself and how you got into the student loan consultation business.
Thanks, Theron. So actually, I met my then girlfriend, now fiance, when she was in her last year of fellowship in Philadelphia at UPenn. So she's a doctor doing urogynecology. And so we got more serious and we had this conversation about finances, right? And then she told me, hey, by the way, I have 6 figures of medical school debt. And I thought, oh gosh, because I was lucky. I went to undergrad, full scholarship, so I didn't have to take any loans out. And so I wasn't really even familiar with the fact that people had student loans and huge quantities.
Lucky guy.
So yeah, it seems kind of silly to say that, after he's talking to so many people that have them now. But so I was a bond trader at the time for one of the world's largest mutual fund companies. And so I was programming in Excel all day, massive data sets. So I felt really great about my Excel skills. So I said, okay, well, I want to help figure this situation out and analyze all the options that we have and figure out what the best one is. And so my fiance, her name's Christine, we delved into Christine's loans and we looked at all these different options, and I was astounded at how complex they were. So because she was a physician and she'd been in training for 7 years, this thing called public service loan forgiveness was a primary part of the analysis, right? And so for your listeners who don't know about public service loan forgiveness, it's PSLF for short. You work 10 years at a not-for-profit institution and you pay based on an income-driven repayment plan. And at the end of the 10 years, whatever balance is left over is forgiven tax-free. So it's basically the biggest backdoor scholarship program in the country, right? And so here I am looking at her loans thinking, okay, she's worked for 7 years at a not-for-profit hospital. She's got 3 more to go and she gets this whole balance wiped away tax-free. Well, lo and behold, she, on the bad advice, unfortunately, of someone in 2012, consolidated her loans. So she consolidated everything. And then she was in a really high cost of living area during her residency. And so she used forbearance after she consolidated several times, and it wasn't because she was irresponsible or anything. It's just because, living in expensive cities, occasionally have some months where you need to kind of put the loans on pause if you're not making a bunch of money. And so all in all, when we submitted all the forms for PSLF, they came back and told us she only had 2 years credit of the 7 that she'd been working. Yeah. On one. That was on one set of loans. And then she had 1 month of credit on the other set of loans. Now that's impossible because, she had at least 2 years on the other set of loans. I'm pretty confident they just lost the paperwork. And so that's how bad, the management of the student loan business is. And, Navient just got sued. You can just look at that to see how abysmal these loan servicing companies are. So anyways, long story short, we studied PSLF and looked at the numbers, and we're thinking about early retirement and not necessarily wanting to be at a not-for-profit hospital for forever. And so since it was on the lower end of the six-figure scale, we actually ended up getting a really great deal refinancing. So we refinanced at like 2.2% and have been paying it back ever since. And now it's below six figures. So that's how I got into this, because after I helped her, she said, that was really ridiculously complicated. You should help my friends. Right. And so I started helping friends. And then I built this spreadsheet and I put it up online, and it got like 300,000 views. And then ever since then, I've been doing student loan consultations for people with six figures of debt and graduate degrees, trying to save them as much money as possible.
Wow. Okay. So that's amazing. I mean, it seems crazy that in today's day and age, we still get, these type of mistakes by the loan companies, not finding paperwork and just giving bad information. It's been, difficult, I think, for a lot of people to get good information about this. So it's good. It's really good. And you're serving a very important niche. So thanks for helping physicians and dentists out, because I know you're able to save them a fair amount of money over the term of their loan.
Right. So I just, for this podcast, I looked up the amount of money that I've consulted on for just doctors over the past 4 months. And so I've consulted on a little bit over $7 million of medical school debt, and then have projected savings for that debt over the life of their loans, right? So this is not like year one savings or anything, right, but over the full, life of the loans, projected savings at about 2.6 million. And that's a lot driven by the Public Service Loan Forgiveness Program, but it's also driven by private refinancing, interest rate subsidies, by switching income-based repayment plans and other things. So, let's talk about people with their student debt. So I get this question a lot, and sometimes people send me angry emails like, why are you charging for something that, you can get for free? And here's this link that says, from MyFed Loans, that you should not pay for anybody for student loan help, and it's always a scam. And that's true, that you shouldn't have to pay anybody for competent assistance on your student loans. But the reason why I think you should is because of a misalignment of incentives. So let's talk about that, right? So the loan servicer that's helping you, they just got off the phone with somebody with $10,000 in student debt who dropped out of college, who's making $20,000 a year, and their goal is to help that person get out of delinquency on their loans, right? And then they have a highly educated physician with $250,000 of med school loans, and who's currently on forbearance during their second year of residency. And that rep, to do a good job, has to have a conversation about why forbearance is a bad idea, which repayment program that you should go for based off of your family income characteristics, whether or not you should go PSLF or think about private refinancing, how you would save for retirement with saving, with paying your student loans. And there's all kinds of conversations that need to happen. And the issue is that the rep on the phone is making maybe $12, $15 an hour, something like that, and got 2 weeks of training. And then, on top of that, they get managed to how long they speak on average on the phone. So if a long conversation needs to happen, then that's just going to fail, right? So the kind of conversations that should be happening with loan servicers, or should be happening even at like med school financial aid offices, I think in large part aren't happening. And if you think about the med school folks, they're great. There's nothing wrong with those folks. It's just that their primary job is getting the money in the first place for people to go to school, right? And they're not really being paid to do that work of having the comprehensive, look and analysis on people's loans. And so the issue is there's a bunch of student loan scam companies out there charge, $500 to $1,500 just to fill out some consolidation paperwork and put you on an income-based repayment plan. That's absolutely a ripoff. What I do is basically charge between $200 for an individual, $300 for a couple, and then I analyze the holistic picture that's going on and compare it to, I run simulations to estimate the cost of all the different options with those Excel skills I picked up when I was a bond trader. So that's basically the issue is that physicians aren't getting the help they need or deserve because of just a failing of incentives in the marketplace. So that's why I started the business, because of what happened to my fiance. I wanted to try to help fill the gap.
Right. No, it's absolutely true. I mean, one of the things that's interesting, I mean, you brought up the U.S. Public Loan Forgiveness Program. And I still have colleagues. I mean, I graduated med school earlier than when this program came into being. And so my colleagues, some of them are still paying back their loans, and, they had no idea about this program. And some of them have been in academic medicine for 15 years now. And I mean, even though they wouldn't have been eligible per se at the beginning, they still would have been able to get some of it written off. And I was talking to a colleague the other day who was like, what's this program? And so he's like, why didn't my financial person know about it? I don't think a lot of them do. I mean, it's just not something that your financial advisor at this point would know about. You're absolutely right. The med school financial aid people, their job is to get you the money, not think about 15, 20 years down the line. I mean, yes, they do think about it a little bit, but it's like you said, it's not their primary concern.
Right. And the financial advisors, I tell you what, when I first started dating my fiance in Philly, she would show me some of the pieces of mail she would get from financial advisor types offering her free dinners, to talk about her, portfolio or her financial plan or something like that. And doctors, probably more than any other profession, are targeted by financial professionals, both unethical and ethical, for their business. And the thing that doctors should understand is that 99% of financial professionals out there are making money by you investing, right? So there's very few financial advisors out there that are going to be making money by a flat fee for making you a financial plan. That's a very uncommon business model. And part of that has to do with how expensive, compliance and regulations are. So they want to make money, so they charge more. And then also the folks want to make a lot of profit. So they charge more, like commission models and assets under management fees and stuff like that. So if you think about somebody who is coming to you in residency, they're not incentivized to know about public service loan forgiveness. They're paid to try to get you to invest money with them, not to come up with a debt strategy, right? So there's no incentive for these financial companies to train their people to know about all of these different loan programs and how they interact with doctors and how doctors should be preparing for them, because there's no money in it, right?
Right.
So I see all kinds of problems especially with commission advisors. That I see that all the time, where people, they basically want to make money as much as possible, and then they're trying to make a sale, and so they give people even bad information sometimes just because they're real eager to make a commission. So I think that with financial advisors, there's very, very few of them in my experience are actually aware of these programs as well.
Right. No, so it's obviously in early career physicians, I think it's critical. I mean, the loans. I was just looking before we talked today about the average tuition now. Here, I'm in Arizona, and the University of Arizona Medical School tuition for in-state, just tuition alone, is now $32,000, and out of state is $53,000. There's a private osteopathic medical school here in town who charges for just tuition alone $63,000, and they also have a dental school which is $71,000 a year in tuition alone. And you figure another $20 a year, at least according to their websites. You figure another $20 a year in housing expenses, insurance, and stuff like that. And at dental school, my goodness, you're nearing $100,000 a year in loans. So I saw in one of your blog posts on your website, specifically dealing with dental schools, about the loans, and dentists have some of the highest debt. Would you talk a little bit about that?
Sure. I mean, so first of all, a physician, when they come out of medical school, as long as they went to their in-state program and, were reasonably responsible in med school, I mean, something between $200,000 and $250,000 is a very standard amount to owe. And it's high, but it's also, especially if you're planning on going into some sort of specialty program, it's right at 1 times your annual income when you get out of residency training. So it's definitely problematic, but it's not like soul crushing of your future financial situation. So dentists, on the other hand, I think it is close to a point of dentistry just not making sense as a profession economically anymore, because like you said, the dental schools, they charge a lot more money, and a lot of this is because they have all kinds of equipment and fees that they charge you, surcharges thousands and thousands of dollars for very expensive dental equipment that they ask you to buy in school. The dental schools, I think, probably are profit centers for universities. So I think that, dental school deans are under pressure from higher up administration to, make that be one of the places where the university is very profitable. And so the typical dentist that I speak with probably has debt closer to $400,000. And like you mentioned, $100,000 a year, I would say that is the norm, $400,000 for a dentist without any financial assistance from their family or spouse. Right. And for somebody who is not that didn't go to their in-state program, so in other words, out of state or private school, I would say 400,000 is probably I would say very typical. It might not be the average, but it's very typical. Mm-hmm. I've seen as high as 550,000. Pretty like at a common level. So 500,000, 550,000 is not that unusual. In terms of worst I've ever seen, I've seen 650 to 700,000 for a graduating general dentist before. Wow. So it's really, really bad. The average dentist income is about 120,000. So if you think about a typical dentist owing $400,000, earning $120,000, the only path forward is being a successful entrepreneur and owning your own practice and trying to make more money in dentistry. That's really the only financially viable path. So if you're just an academically oriented person, super interested in the study of dentistry and all that, you're really not going to be well served going into the profession. Now, under current rules, though, kind of oddly, you might be able to utilize the public service loan forgiveness program and get some of it forgiven if you go be a professor at a dental school. But for somebody just going into the labor force as a dentist, it's very challenging, right?
Yeah, that's 400,000 being typical is just unbelievable. I can't see how this type of expenses are sustainable, yet they've continued to increase for the last 20 years or 40 years, whatever. So yeah, I think you're right. I think we're hitting a head or so. I mean, law schools have kind of hit that point in the last 5 to 10 years where people are just, they can't find jobs after law school. They've been paying so much in tuition, and I wonder if we're nearing that point now for dental school, and I wonder if it's similar for other allied health fields. Pharmacy, optometry. None of those schools are cheap. So. Yeah,
well, I can tell you because I speak with all of them, even including lawyers sometimes, and the optometrists are not in good shape at all. Really high debt to income ratios. Probably the worst I see on a consistent basis is veterinarians and chiropractors. So veterinarians usually have like 300,000 in debt, and they have, at least the ones that talk to me, and they have incomes maybe of about 70,000 starting, rise up to maybe 80,000. So think about that. Your debt to income ratio is over 4. Wow. And the only reason why we're not reading about veterinarians starving in the streets is because of the income-based programs where you can pay a percentage of your income. If something ever happened to those programs, the entire profession of veterinary medicine would implode. And, the entire profession of dentistry would probably implode, though less spectacularly. Right. Because, if you take out taxes and loan payments, then the dentists would have about 30,000 left over. The veterinarians would have nothing. So the chiropractors are actually even worse than the veterinarians because the economics of that field is very challenging. A lot of areas are really saturated. Most of the programs are for-profit schools, so they, are really bad about misleading people and making very misleading statements about the value of the education. Mm-hmm. So I see lots of chiropractors with $250,000 in debt, maybe $40,000 to $60,000 incomes. Wow. And I've had people that have changed fields and just ditched the chiropractic field because of how bad it's been. So, physicians of the medical field, I mean, I guess I should say pharmacists, they're usually about a debt to income ratio of about 1.5. So they might make 100,000 and have 150,000 of debt. Okay. And a lot of pharmacists though will figure out a way to work during school, right, or they'll figure out some sort of way to keep the debt down that way. And so, I rarely see a pharmacist over 150,000 in debt, though it does happen. Mm-hmm. And so I would say pharmacists are in a good position to pay back their debt, but they're not economically where I would go personally if I had to choose a job because their income is very capped. Like once you get to a pharmacy manager level, you really don't really have much of an opportunity to have your salary increase, right, unless you run your own pharmacy, and that's very difficult. Right. So physicians are even with all the student loans, physicians are at the very top economically of the medical field in terms of, who's the best off with the current student loan policies. And it's primarily because of the public service loan forgiveness program.
Right. Now let's, you mentioned the other programs such as the income-based program. Talk a little bit about that.
Sure. So not everybody's going to work for a not-for-profit hospital. And for the people that let's talk about the people that are, very economically challenged first. And then we'll talk about the people that are really, the opposite of that.
Right.
That are making gobs of money and still have a lot of debt. So the people that are very challenged in paying their debt, like a veterinarian. So how does a veterinarian with $300,000 of debt and a $70,000 salary survive? And the answer is you make use of one of the three income-driven repayment programs. So you have REPAYE, which is the revised pay-as-you-earn program, PAY, which is pay-as-you-earn, and then IBR, which is income-based repayment. So those are the three major plans. The differences between the three, REPAYE and PAY, are 10% of your discretionary income, and then IBR is 15%. So you have these three options to choose from. It's a little bit more complicated in terms of which one you're eligible for. Mm-hmm. But in general, the people that are economically challenged will sign up for pay-as-you-earn or REPAYE, and then that will mean 20 to 25 years of payments based on their income. So you're a veterinarian, you're making $70,000 for it's a little bit more complicated than this, but say you pay about $7,000 a year in loan payments. So then you make that $7,000 adjusted for your income payments every year for 20 to 25 years, depending on your program that you're on. And at the end, the balance is forgiven, but it's taxable income. That's a big difference between the PSLF program. So you might hear of like private sector loan forgiveness. That's very different from public sector loan forgiveness or public service loan forgiveness. Mm-hmm. So private sector loan forgiveness is you're on REPAYE or PAY or IBR for 20 to 25 years, and then the debt is forgiven after those payments over that time frame. And the issue is you're going to owe taxes on whatever is forgiven because the IRS treats forgiven debt as taxable income.
Right.
So that's the plan. I mean, that's what the government's rules are currently set up to do, is to charge all these people in 20 to 25 years, taxes on whatever their balance is. And so for a lot of these people, they're going to owe 40% of a huge sum. And if you're economically disadvantaged, you're not going to be coming up with, 40% of $300,000. You're just not going to do it.
Right.
So I expect there's going to be mass defaults and the tax penalties for a lot of these professions that are no longer economically viable. And I think that's going to happen. These programs all started in 2007. Okay. So you're not going to see this happen at all for another 10 years before you start hearing stories. And then once you start hearing the stories, then I think Congress is going to be really pushed politically to pass some sort of like bailout bill for student loans. And then my guess is, you might have some sort of change in the tax treatment of forgiven loan balances. And I wouldn't bank on that if I was a borrower, but I think that's a possibility.
Sure.
And so that's like for the folks that, owe more than 2 times their income basically for their entire career. That's the program that I would do. So I would help them figure out which one is the best of those three, and then figure out how much they need to save for their tax penalty so they don't default on the tax penalty just in case. Mm-hmm. And then you're basically hedging your risk because you're saving for the tax penalty. If the loans get forgiven, then you have this money you get to keep, and if not, then you don't have to declare bankruptcy or have a tax settlement with the IRS because you'll have the money to pay.
Right.
So that's what I do for somebody who's deeply in debt. For somebody who's awesome, just has, in terms of their income, just has unbelievable amounts of income. So say like I helped an orthopedic surgeon a couple months ago who was making, I think, maybe $350,000 or $400,000 or something along those lines. Mm-hmm. And then his debt was slightly less than that. So he had gobs of medical school debt,
right.
But he also had gobs of income. And so my question for him was, do you work at a not-for-profit hospital? He said no, he works at a private facility. And I said, okay, great, because that means that we can actually refinance this and save you a lot of money on your interest. So in his case, he had already figured out that he should have refinanced. So he refinanced himself about a year before he talked to me. Mm-hmm. And he refinanced into like a 4.8% loan down from a 6.8%. But he refinanced into a 15-year term variable interest rate, which means the interest rate can go up and down, right?
Right.
And so he was at 4.8, and I said, well, how many places did you shop around for an offer from? And And he said 1. And I said, well, if you're buying a car, would you go shop at? And I was just saying this jokingly, of course, not criticizing him, but just saying, if you went to shop for a car, would you only go to one dealership, without looking around at other ones? And of course not, right? So I helped him shop for interest rates for multiple different places, and we got him down from 4.8 down to 3.04 for a 10-year, so shorting the term. And it was also variable, but still he was saving about almost 2% in interest, and on 300,000+, that's about $6,000 a year in interest that he was just giving away for free. So.
Yeah. And unlike mortgage interest, this is not generally tax deductible once you're at the higher income levels. So
correct.
Absolutely, it's just money in your pocket.
Yeah, so I say that student loan interest is absolutely the worst interest you can possibly have, because I guess except of course credit card interest or something like that. But most people that graduate med school, that they either have a very small amount of that or they pay it off real quickly once they start making an income. So really, like of the common debt that people have, student debt is the worst because of the lack of tax deductibility. So a 6.8% rate is actually much higher than that, because say, just to make the math a little easier, say that you had 5%, 5% student loan, and that's not tax deductible. Well, you actually have to gross that up for taxes to make it equivalent. Because say you have $100,000 in student debt, it's $5,000 in interest. Well, to come up with $5,000, since there's no tax deduction, you actually need to earn more than that to pay the interest, right? So just trying to talk through this for your listeners. Yeah. So say that you had a top tax bracket of 40%. As many of your folks will, like in a place like California. In that scenario, you would need to earn about $8,300 to pay the $5,000 of interest. So in other words, instead of a 5% rate, it's really 8.3%. So that's why student loan interest is so bad. There's a couple scenarios where you might let it hang out for a long time. It's rare, but occasionally people will have really lucked out, and they'll have like 2% or 3% on their student loans, and they feel pretty confident they can earn more money in that in Vanguard index funds or something along those lines. And I tell those people, I say, more power to you. That's fine. Go ahead and do that. But 90% of people out there are sitting on 5% student loans or higher, and you either need to figure out a plan to pay them back on the public sector loan forgiveness program and have everything optimized for that, and have that be your very intentional strategy. Or if you're working at a for-profit institution, or you're planning on leaving a not-for-profit before you get the 10 years of credit towards the program, the forgiveness program, then you do the private refinancing, and then you need to shop around in a bunch of places and try to get the best rate. So, that's basically what we do in these consults. If people can go and look at studentloanplanner.com and check out all of the articles that I've written about this stuff. But yeah, I mean, you just can't have student debt laying around like most people do and not have a plan for it.
Right. Well, let me ask you a couple of thoughts about that, because you mentioned the non-tax deductibility of it. Do you ever mention to people, take out extra, like a home equity line of credit or, mortgage, and use that to pay down your student loans? Is that a consideration?
Yeah, you could do that, but that raises a couple concerns. So the only time you'd ever do this, right, is if you were not eligible for the Public Service Loan Forgiveness Program, PSLF. If you're eligible for that, focus on that. Don't touch your student loans. Actually, come up with a plan to handle them, that incorporates that. But say you are, a new doctor at a private, employer or something like that, and you want to save as much money as possible. So it really depends on, first of all, how much home equity you have. So I think a lot of the times the banks that I've seen, they only will take you up to 20% loan to value ratio. So if you have a $100,000 house and you own 30,000 of it, they'll only give you a loan for $10,000 until you have, 20,000 of equity in your home instead of 30,000.
Right.
So first of all, the amount of money that people can usually get out of their home for a home equity loan for student loan refinancing or paying down student debt is limited.
Right.
And then in the case that it's not, I've seen a couple people in California where the market there has been exceptionally good, and they have a lot more than 20% of equity in their home. And in that situation, I'm fine with it because it is tax deductible. But the things you have to realize is student debt, if you die, it dies with you. If you become disabled and become a quadriplegic, your debt dies. And with a home equity loan, if you die or become disabled, the debt's still yours because a mortgage doesn't go away just because you die or become, disabled, right?
Right.
In terms of it gets assessed against your estate. So if you convert your student debt into a home equity loan because of the better tax treatment, then you need to have certain protections in place. So you need to have, if you're married, especially if you're married, you need to have a term life insurance product or a term life insurance policy. I usually just tell people 20-year term of at least 8 times your salary, or if you're looking at your loans, I would say, many multiples of what you're borrowing.
Right.
That would, if in the case of your death, it would cover the home equity loan. It would cover, the lost economic value of your life to your spouse. It's really important to have term life. So just so you know, term life is very different from whole life. I tell people never buy whole life.
Right.
Term life is 90% cheaper, and it actually does what it's supposed to, which is just give you insurance against a horrible thing happening.
Right.
And then also you need to have disability insurance. So a ton of physicians do not have disability insurance. It's not a great product to buy, like from a customer experience standpoint, but it's an important product to buy.
Right. So,
you basically have to work with a commissioned agent. Just try to find one that will shop around from several different companies before selling you a policy. Try to pick one that covers, only the amount of income that you would need to, service your debt and take care of your living expenses and those kind of things. You wouldn't necessarily want to insure your full physician, salary, because frankly your lifestyle would change in that unfortunate scenario. But yeah, so you could totally do a home equity loan. You just need to have term and disability insurance to protect against the downsides.
Right. Okay. So along that line, how about these new online, like social finance kind of companies in terms of, refinancing your student loans? What has your experience been with them?
Yeah. So they're great. The one thing I'll tell you is that there's a lot of companies out there. So just so folks are aware, all of these companies are basically funded with venture capital, right? Right? And so they're very much in the fast growth, expand as fast as you quick stage. And there's really lots of talented people working in these companies, and they're all competing against each other ferociously for your business. And so because of that, they are willing to spend a certain amount of money on customer acquisition. And so I think they don't care if that comes in the form of advertising expenses or, if somebody reads a blog and the blog sends them there through a link and the blog gets a commission or a bonus for sending people there. They don't care where that comes from. Right. And so what I have done is, I guess because I've sent enough people to these companies, I've negotiated referral bonuses, both for myself and for anybody who wants to use that link. Okay. So those referral bonuses are typically between $200 and $500. Mm-hmm. And so basically I want to split that referral bonus with clients. Right. There's a lot of sites out there that will not split that referral bonus and will not really clearly disclose to you that they're earning a referral bonus from you clicking a link and refinancing your loans. Right. And so the issue with that is like you have to make sure that it's the right thing to do, right? Refinancing with SoFi or DRB or Common Bond, Linkey, Earnest, all Credible, all these big refinancing companies. It's a great decision if that's the right way to go. But just realize like there's a lot of content creators and places out there that are trying to make a lot of money and trying to get you to refinance your loans. And it might not be the right thing for you. Right.
So, because once you, you said before, if you're eligible for the U.S. public loan forgiveness, if you refinance or consolidate, that's it, right?
That's it. You can't reverse it. I talked to a counsel at a hospital, not-for-profit hospital the other day, and he refinanced his student loans and was eligible for PSLF and didn't realize it. And he contacted me in a panic, kind of saying like, is there anything I can do to reverse this? And I said, I'm sorry. How long has it been since you refinanced? And they said a few months. And I said, well, that's it then. You can't reverse it. And it sucks. Right. You can't cry over spilled milk, I always say. Right. But yeah, once you're refinanced, you can refinance again, like I
Sure.
did for that orthopedic surgeon. It's like a mortgage. Like if you find a better rate, absolutely refinance again. But you just need to know that it's the right thing to do. And just so folks know, I get common questions about this, so I thought I would just mention this. There's generally no prepayment penalties for student loan refinancing, so that's great. There's really usually no origination fees either. It's almost kind of like the opposite of the origination fees. If you go through one of these bonus links, like my own, on studentloanplanner.com, like you can, in the sidebar for my blog, like you can click those links, and it's kind of nice contrast to mortgage lending, because mortgage lenders will always charge you an origination fee for the loan. And in fact, I don't know if people realize this, but when you go to school and take out the loans in the first place, the U.S. government charges you origination fees on your student loans. So that's one reason why the loans get so high, is the government charges you anywhere from 1% to 4.25% origination fee for every dollar you take out.
Right.
And then you tack on 4 years of accrued interest, which accumulates while you're in school. And that's why these balances are so high. And a lot of people think they think, $31,000 a year for Arizona med school and $20,000 for living expenses, $51,000 times 4. I'm going to owe $204,000. Well, that's actually not the case, right? You have to take $204,000, add on maybe $50,000 of accrued interest, and then tack on another $10,000 of origination fees, and now you're at $260,000.
Right.
So I just thought I would mention that, just because we were on this talking about,
No, absolutely. I think that's true. I think the sticker price, when we're shopping for a car, the sticker price is what you max, you never want to pay that sticker price, but that's the max. In this case, it always ends up being the lowest, but and it's never that low. And you're absolutely right. You always are paying much more because we just don't factor in these other things. So I think that's a very good point. One of the other things, that especially in primary care, they have loan forgiveness programs that are separate from the U.S. loan public service program. And I don't know how many people this applies to, but if you're going into primary care, especially if you are from a state that's really in desperate needs. I mean, I've seen loan forgiveness up to $150,000 in like I think Texas, and almost $200,000 in South Dakota if you're willing to practice for a set number of years. So, not saying that's for everyone, but definitely something to look into, because I don't think that's specific to primary care, and unfortunately, like we talked about some of these other professions like veterinarians or pharmacists or whatnot, I don't think that's eligible. So, or they're eligible for those type of things. So, definitely look into these type of programs if you are going into primary care and would be willing to participate, because I'm not sure about the tax write-off on those things, but at least you wouldn't probably pay the state taxes on those. But look that up. I'm not definitely sure about that.
I think it should be. Yeah, it's probably going to be specific to each state. I have to check and see what the rules would be.
Right.
But there's all kinds of real specialized programs, and it's worth. Like if wherever you are, if like you said, if you're a primary care doctor in, I don't know, Colorado or North Dakota or whatever, wherever you are, like Google that, like Google,
Absolutely.
Primary care, doctor loan forgiveness, South Dakota, and just see what's out there, because a lot of times some of these highly in demand specialties in these rural areas will have these kind of loan programs. I know Oklahoma, for example, has $25,000 a year for dentists if you apply and get accepted, and if you're working in an underserved area. So, if you go to Oklahoma, you could potentially get up to 100-something thousand in loan forgiveness just from their state alone. So that's a tremendous benefit that's definitely overlooked and should be brought up. And if you think about it, I actually have written an article about this for my blog. The student loan policies right now actually incentivize specialty programs instead of primary care, which is the exact opposite of what, you would think that they would want to do, right?
Right.
And the reason is because if you're you're like a family doctor and you do, a 3-year residency or something along those lines, you start making an income a lot sooner than your peer that went into, orthopedic surgery, right?
Right.
And so the primary care doc is only taking advantage of those low payments based on their income for 3 years, and then they might jump up to $130,000 or something, $140,000, and then they have to pay 10-15% of that. So then they're paying $14,000 a year on loans, while their peers are paying $3,000 a year on loans, still in training, right? And so then the orthopedic doc or the neurosurgery resident or whatever, might have had 5 to 6, 7, 8 years of paying $3,000 a year,
right?
And then they go out and become an attending, and they're only paying real high payments on their loans for like 2 years, and then the primary care docs are paying high payments on their loans for maybe 7 years. And so the way it works out is it's actually a lot more lucrative, especially if you have a lot of student debt, to be a specialist because you get more in loan forgiveness,
right?
Which is exactly the opposite of what you would as a policymaker try to do, because you're trying to encourage more primary care doctors.
Absolutely.
And we're kind of doing the opposite. So it's I think PSLF stays are numbered, right? And a lot of doctors ask that to me. They say, "What do you think about PSLF?" Because I'm depending on this,
right? And
it's a lot of the more savvy ones, like that have really looked into it and understand it. They're like, "This is my financial future." Like, if this goes away, like suddenly this $350,000 debt I took on for private medical school becomes real.
Right.
And what I'd say is to your listeners is, like, anybody that already has debt and it's already, out of medical school, in residency programs or working, you're probably safe, in terms of using PSLF. I mean, the repeal proposals that have, been presented grandfather in current borrowers. And what I mean by that is anybody that already has loans, the loan docs have already been signed.
Right.
They already have taken out the debt. They're already having to deal with them with your loan servicer. Those folks are current. And it's probably going to be the case that those folks will get to use PSLF. The folks that probably will have to deal with a changed version of it are people applying to medical school right now.
Right.
So that's potentially scary for them. But I really do see public service loan forgiveness going away because it's extremely generous. I don't think the government ever intended to benefit high income earners with it.
Right.
And President Obama tried to cap it at $57,500 max in benefit. And that would effectively repeal it for medical school people.
Right.
And then the Republicans repeal it entirely, but they grandfathered in current borrowers. So those are the two repeal proposals I've seen. The first person on PSLF will start getting forgiveness in October 2017 of this year. But so when we start seeing that happen, I think we're going to see a lot of really interesting results. And I think in 2019 is the first massive class of public service loan forgiveness folks. So when you see that happen, I think Congress is going to look at that and say, "Oh my gosh, this is a benefit of billions and billions of dollars that we've not been, putting aside money for.
Right.
Let's stop this." So I think that's what's going to happen. It's just going to take some time.
Right. Right. So, yeah, I mean, as we were saying, I think you mentioned before, hedging your bets is probably the best thing, but talking with you, directly and kind of getting a better picture of your full financial picture would probably be the most helpful thing. Well, Travis, listen, I want to thank you. You gave a ton of good information here. Tell me again, tell our listeners again where we can find out about you and your service.
Sure, for sure. Well, first, if anybody has any questions at all, I'd love to hear from you. Just email me at travis@studentloanplanner.com. That's travis@studentloanplanner.com. That's my email. I'll answer every one of those personally. Okay. And then if you want to just read, free content, that's cool too. Go to studentloanplanner.com and you can click on the blog tab and check out all of my free articles, and you can sort it by the doctor category or the dentist category. And then if you wanted, a bonus for refinancing your loans, I got those links on the sidebar there too. So, and also the spreadsheet that I built, they got the 300,000 views. That's the latest version of that is also on my website for free. Awesome. For folks that want to play around with it and see what their loans would look like. So yeah, love to hear from you guys, from your listeners. And, I'm passionate about helping folks save money on their student debt. I enjoy it a lot more than making millionaires and billionaires a lot richer by managing their portfolios like I used to be doing. So, it's fun.
Right. Right. No, absolutely. Well, we thank you too, because I think that the main goal of this podcast and a lot of this financial movement recently is just for people to take control of their own money, know what it's doing, make the best use of it, and therefore, you can achieve your financial freedom earlier. So, Travis, I want to thank you once again, and we'll look forward to talking with you again in the future to see how the student loan, your business is going, and just changes in the student loan industry.
That'd be awesome. Thanks so much for having me, Theron.
All right. Thank you, Travis. Thanks for listening to another episode of the Dr. Money Matters podcast. I want to thank my guest today, Travis Hornsby of StudentLoanPlanners.com, for appearing and discussing student loans. student loans, as we mentioned, have become a increasing burden to all of our health professional colleagues. But I didn't realize before this episode that our colleagues in the veterinary field are particularly burdened by this. So I want to acknowledge them for what they do. I want to thank you guys for your support in this podcast, and I want to give a shout out to Can Indian for the first 5-star review on iTunes. I appreciate that, and continued podcasts are coming. So just keep subscribing on iTunes or Google Play, and if you can, please leave us the reviews on your iTunes app. I want to make sure that I'm giving the listener the topics that they want to hear, and I want to get some feedback from you. So please send tweets at Dr. Money Matters, or messages on Instagram, Facebook, or at comments at drmoneymatters.com.